Welcome back to the Wolf of Property and Casualty. I'm your host, Derek Lasniak. With over 15 years of commercial broking experience focused on the middle market, upper middle market, national account space. The Wolf of P&C is a practitioner-led podcast designed for brokers, buyers, and insurance carriers. No bullshit, straight talk each and every time from someone who's actually lived it. Today's topic, and big shout out to ChatGPT for its help in making this very enthusiastic graphic. But I've been on a little bit of a work comp kick lately, talking about work comp, talking about claim reviews. And I want to talk about a topic that I think gets overcomplicated, and it's loss sensitive workers' compensation programs. And for those of you out there who have some familiarity with this or no familiarity with this, I want to spend the next 15 minutes or so talking about what this is conceptually, some of the things that I did to sell this type of product. And before we get too far down this rabbit hole, I want to be clear. This is a financing mechanism. Traditional work comp, we'll call that guaranteed cost programs that we've talked about on this show, are going to be your traditional insurance. They are going to take the payroll, usually divided by the class code. So you have clerical, you have whatever manufacturing code or construction code, and you take that payroll for those codes times a rate, either set by the state or dictated by the insurance carrier, divided by 100, and you add up all those premiums per code, and then you take things out like experience mods, premium discount, etc. And what at the end you get to a premium number. You'd agree to pay that premium to your insurance carrier, and in exchange, you could have a million, $2 million, $3 million of losses, and the insurance carrier loses because you've locked in X amount, or you could have no losses and you still owe all that premium, and the insurance carrier keeps that all as profit. And work comp is work comp. It is there to pay. It's a sole remedy there to pay for injuries, lost time, and potential disability as a result of injuries that are suffered in that are compensable, that are suffered in the course of doing business. When you get to these things called loss sensitive work comp programs, these are typically going to be designed for larger customers, but this is nothing more than changing the financing mechanism. So in the first example, the guaranteed cost, which is really common, you agree to pay a certain kind of premium developed in that formula, no matter what your losses are. On really bad years, you win because you've locked in your premium, and on really good years, the insurance carrier wins. What we're changing is not the structure, not what the coverage is in a work comp loss sensitive program. We're just changing how the financing mechanism works. And these programs, specifically what I'm going to talk about today, a retrospective rated program, they are going to be for customers that have reached a certain size. And size isn't just some term that you have to be big enough. What size equates to is actuarial confidence. Once you get to a certain size of your work comp program, there is something that happens with your data that it becomes easier to be predicted. We know what losses are going to look like after you reach a certain size. Shock losses can be absorbed in the structure of the premium. Who should be looking at these? So for brokers out there, if you have a buyer that performs well on their work comp, let's say they have a mod that's under a 0.9 and their standard premium, their guaranteed cost premium is in excess of $600,000, $700,000, you should absolutely be having this conversation. Buyers, same for you. It is not to say that the math is going to math when you're at $500,000, $600,000, but my success with these types of products were that they don't get purchased. You don't switch from a guaranteed cost program the first time you see it. You're going to need to be educated. Every time that I moved a client due to their size and their performance onto a retrospective work comp program, I did so on probably year 2 or 3 because the concept and some of the things that I'm going to talk about today are not changes you make overnight. Most insurance buyers are used to, I'm locking in my premium. I can book that on my financials. And I know no matter if I have losses or not, that's my cost. This program, a retrospective program, is going to change that. You're going to participate, much like they have in their health insurance. You're going to have some participation that's going to move around based on your performance, but it can also be incredibly profitable. Go back to that guaranteed cost program. Let's say your guaranteed cost premium is $500,000. You give that to your insurance carrier and you have no losses. And you're sitting there saying, shit, I had no losses and I still paid $500,000 in premium. These kinds of programs, when you reach a certain size and scale, allow you to say when you have those great years, not only are you not necessarily losing that premium to the insurance carrier, but the timing of which you pay the funds, so the cash flow becomes even better. So I would say when you have a customer that's operating in a consistent way and is being better than the average, meaning they have a work comp experience mod, but certainly below one, but typically below zero point 0.9, they are a good candidate for a retrospective rating program, especially if they have the ability to take on some risk. But you should start talking about this at that $500,000-600,000 mark, where I think it becomes really, really more of a no-brainer is once your guaranteed cost premium is going to be over $1 million. And that's not always the case. This is something that brokers out there, if you're not talking about it though, I'm going to come in and talk about it. And even if the client doesn't necessarily want to go to this because they don't like the risk, I'm going to look like a really smart person because I brought it up. So much about being a good broker is bringing things up and then putting them away. Bringing things up, maybe not right now, but at least I educated you. Your job is to show all the options. It's the customer's job to see if it's for them once you've explained it thoroughly. So there are two types of retrospective work comp rating programs, and I want to cover this at the beginning. One is called an incurred loss retrospective rating program, and one is called a paid loss retrospective rating program. These are not highlighted on this fancy sheet that ChatGPT made for me. The difference is conceptually what I'm going to talk about from here on out isn't going to change, but the difference is between how you pay for this. A big part of a retrospective rating program or a pay for your own losses type of program comes down to how the losses and how you pay. When you talk about a premium that's $2 million, you're talking about how I pay for that mattering. If I have to pay $2 million up front, I prepay my policy. That's a lot different than paying for my policy over the course spread out over 18 months because I have the value of having that cash before it goes out. So the two types of retrospective rating programs, one is called an incurred loss. And if you remember from our other episodes, what incurred means is that the value of the loss when the adjuster puts a dollar amount or puts a reserve on that claim. So a shoulder injury comes in, they think it's going to need surgery. The surgery is not for 2 months, but we know a shoulder surgery costs $100,000. We're going to put an incurred value on that, a reserve of $100,000. That's my incurred for that claim, even though I haven't paid out 100,000. Paid means that we're not gonna put that incurred number on there. We're just going to value the loss as the bills get paid. So when you come to a retrospective rating program, you can add one of two different ways to which you fund that program. An incurred loss, which is far less risky to the insurance carrier, means that as they reserve it, you're going to get a bill. So a month goes by and you've had three claims that happen. And over the next 6 months, those three claims are each valued at $20,000. They're going to pay out $60,000. That first month in your incurred loss retro program, you are going to be billed for $60,000, even though it hasn't paid. A paid loss retro says you got three claims that come in $20,000 in that first month, and you're only going to be billed maybe $5,000 for the first doctor's visits of those three claims in the first month. And then the next month, they're going to get billed 20 up until the final bill is cut. You're paying as the actual insurance carrier is paying the bills. Now, the paid loss is more risk for the insurance carrier because they're essentially banking on you having the money when the bills come due. They're taking some credit risk on it. That means that a paid loss retro is going to always require you to post some collateral with your insurance carrier. In case you go out of business or in case you can't fund, keep in mind, losses might be able to go on for 18 months, 2 years down the line. So that credit risk, knowing that you only owe the insurance company, you reimburse them at the time that they pay the loss, that credit risk comes with collateral, usually in the form of cash or a letter of credit. Right now, that letter of credit might cost 8%. So one of the very first things you have to talk to your clients about is, do you have the stomach and do you have the credit capacity to post collateral to your insurance carrier since they are going to be fronting you the money? On an incurred loss program, you pay as soon as the claim comes in and then the estimate of what that claim costs. So there's less credit risk to the insurance carrier. Therefore, you typically might not need to post collateral. Not always. You still might have to just because of timing, but the collateral required might not be there if your financials are sound. So those are the two types. The rest of what I'm going to talk about doesn't vary between the two types of programs. But one of the first things you have to diagnose with your customer when talking about these programs is, do you have the stomach to share in the risk? If you want to beat the system where you have zero losses and instead of writing a $500,000 check for your work comp premium or 900,000, you want to beat the system where you don't necessarily have to fund all that and you don't get to let the insurance carrier win in those really profitable years. You're going to have to potentially put up some credit risk to the insurance carrier because they're going to be fronting you cash, but you are going to be able to pay for losses as they arrive. So how do we break down what a retrospective program is going to look like? Throw out everything you know about guaranteed costs. When you have a guaranteed cost program, how does it typically look? Just like I told you, payroll times rate divided by 100, add them all up, minus the experience mod, minus premium discount. Here's my premium. Good years, bad years, my premium doesn't change. That's going to be the number. In a retrospective rated program, they are developing not that standard premium, but they're developing a basic premium. And the basic premium is going to be a rate, a blended rate, essentially, that's going to get multiplied by the total payroll of the company. What really comes down to developing my basic premium is my total payroll, clerical, everybody's payroll, times the basic factor. Now, the basic factor is going to be developed by the individual insurance carrier offering you a retrospective program. That basic has got their profit, it's got their reinsurance costs, it's got underwriting expense. I've often said to most insurance underwriters when I was quoting these programs, a retrospective rating program is like a home run for the insurance carrier because while your customer is getting the benefit of paying more aligned with their actual losses, the insurance carrier is getting that basic premium right out of the gates. They're building in the profit. The insurance carrier no longer has the other side of the coin, the risk. They no longer have the year where you paid 500,000 in guaranteed costs and you had 2 million in losses. They're locking in their costs, their expenses, and their profit in that basic premium. So the very first number you get is your basic premium when it comes to handling your retrospective. And that basic is going to be total payroll times whatever the carrier comes up with. That basic premium is typically what you're going to pay in your installments. So on $1 million work comp guarantee cost program, your basic premium might be $300,000. That's going to be what your 10 equal installments gets paid out at, is that basic premium. Now, as I told you, the retrospective program is super nice. You're going to pay for the losses as they occur, either on an incurred basis, meaning you pay a bill at the end of the month for what the reserve is of the total claims, or a paid. You're just reimbursing the insurance carrier as they pay those losses. Your carrier is also going to come up with a loss pick. This is where the actuarial nature of retrospective rating programs come up. Typically, they're going to look at 5 years, maybe more, of your actual historical performance while you're on a guaranteed cost program or whatever program you've been on. That loss pick that's going to get run through an actuarial database is going to say, here's what I expect your losses to be. So you have the basic premium, payroll times the basic. That covers all the fees, profit, underwriting expense, all the things that go into just being an insurance company and taking on the risk. Then typically you're going to add in the loss pick. So if you're on an incurred retrospective rating program, you have a $250,000 basic premium and you have a $600,000 loss pick. That's what the actuaries at the insurance company think that you're going to have in losses. Most insurance companies on an incurred loss are going to say, okay, you pay in your basic of $300,000 on 10 equal installments. We're also going to have you funding the loss pick in that first year. So we're going to add 300,000 to 600,000. Your premium is $900,000 that you're going to fund for that incurred loss. Now, at the end of the year, you're going to get all that $600,000 back if you don't have any losses, but you're going to fund it for us because we're not necessarily going to take on that credit risk. Every carrier is different. Some carriers, especially in subsequent years, will let you just pay that basic premium and you won't necessarily have to fund your loss pick. I worked a lot with one specific insurance carrier. You were pre-funding that loss pick in the very first year. And then if you had enough reserves piled up, you wouldn't have to necessarily do that. So they're going to come up with some combination of your loss pick and your basic. That's what you're paying for. Then you're going to get a bill every single month, whether you're on an incurred or a paid loss retro, you're going to get a bill. I had 7 losses this month. Then the incurred is $80,000. You're going to pay it. The nice thing about this, though, if you go the first 4 months and don't have any losses, think about your guaranteed cost program. You're just paying a set amount. In this program, when you think about larger numbers, you're only paying as the losses happen. So if you don't have a lot of losses in the first part of the year, you're getting the benefit of holding on to your cash before it's due. This is a program that benefits people with larger work comp expenses and those that value cash flow and those that value paying for their actual exposure. Some important other factors that you got to look at. These are the things that are really important when it comes to structuring your retro. A minimum and a maximum. The program is always going to have a minimum that includes the basic premium. That's the minimum your program costs even if you have no losses. But there's also a maximum. Nobody would take these programs if they knew that they had to pay for every loss. That maximum, though, is going to be way above what you're guaranteed. Let's say you had $1 million guaranteed cost premium. Your minimum might be $300,000 and your maximum might be 2x that $1 million. So it might be 2 million. There is a maximum to say in the worst case of the worst case, these costs don't go on forever. The other important things to keep in mind is that how are the carriers, every carrier is different. How are they putting things in there for loss control? Are they building in $60,000 in loss control? It's your job as a broker to negotiate that for claim reviews, for RIMIS system. Once you get to this size, most insurance carriers are going to say, hey, the cost to access our RIMIS system to slice and dice your data is $50,000. I would often tell insurance carriers, we don't need your RIMIS system. I don't want to pay for that. This feels like a hidden profit center. These types of programs, because everything is a la carte and everything is pick and plug, you have a lot more ability to negotiate these cost centers. And it's really important that you look very closely. The next thing that's really important is a decision you're going to have to make between a loss conversion factor and a per claim handling charge. I was really an advocate for per claim. So you pay your basic premium, that's covered the insurance carrier's costs and expenses. Then as the claims come in, whether you're on a paid loss or an incurred loss, you're paying those bills every month. Every claim is going to have a cost because the insurance carrier now is very a la carte. They're saying, look, if I'm touching a file, I'm going to bill you for the cost. Most insurance carriers have a per claim handling charge or a loss conversion factor. The per claim handling charge is going to be $200 or $300 for a medical only claim, one that's supposed to be like this and done. And then a lost time claim might be $1,000 or $1,200 because there's way more involvement. The adjuster's got to follow up. There might be a nurse case manager assigned to it. Most carriers will offer you two ways to get billed on top of the claim expense itself. The first is a per claim charge. You lock in a number, whether it's $1,000 for indemnity or $200 for a medical. The other way, which is historically more common, is what's called a loss conversion factor, where the claim total amount gets multiplied by usually 10%. So a 1.1 loss conversion or 1.08. That means that the total claim, as that claim rises, the handling cost for the adjuster is built in on top of that 8 to 10% typically. If you can get a per claim handling charge, most of the time, I think my clients understood that. That way, you don't have a $200,000 claim that might cost an extra $20,000 for the handling charge. Some carriers are reluctant to do that because, again, in these programs, the thing that I always looked at is there's more hidden profit centers. And I always would get really fucking pissed at insurance carriers because right at the very beginning, if you go back to what I said about the basic premium, they are in theory locking in their profit no matter how you perform. The rest is they're like a TPA, they're just handling claims for you. I don't expect you to make profit in the handling of work claims. I expect you, if you have your profit built into that basic, to just make your profit there. I have had a lot of customers that have migrated to these programs, mainly because you can't outrun the profitability and the cash flow benefit, specifically when you get over $1 million in guaranteed cost programs. But not all the time. Certainly in states like Wisconsin, for example, where you have dividend environments, it's not necessarily that just because you're big, you have to be on a retro program. The other thing is once you go on a retro program, it's really hard to go back off a retro program. I mentioned on those paid loss programs where you have collateral, that collateral is going to sit there until the carriers have closed out every claim. So this decision is not one you make back and forth. It's a lot like what I talked about in the group captive space. But what's important here in this brief overview is understanding that these programs exist and talking to customers about them before they're even necessarily big enough to introduce these ideas. And for brokers out there who aren't comfortable in this space, talk to your insurance carriers, talk to United Heartland, talk to your big work comp carriers. I learned a lot of what I needed to know to feel confident in these programs from the insurance carriers themselves because these are tricky and it's a different philosophy and it's a different way to analyze your risk.